Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and we have a great guest today. We have Craig Hurvitz, who's our National Director of Industrial Research at Colliers. And I was on a national call with Craig a couple weeks back, and I told Matt, I said, we got to get Craig on the podcast because he's really dialed in, super knowledgeable when it comes to industrial. And so, Craig, it's great to have you on the podcast. Thank you for joining us.
Hey, thanks so much for having me, guys. Appreciate it. Glad to be here.
Yeah, it's great. It's great. 2023 has been an interesting year. I want to start by asking you, what surprised you the most in 2023?
You know, despite all kinds of headwinds, so fears of a recession, the interest rate environment, capital markets activity falling off a cliff, fundamentals in the U.S. industrial market really remained pretty strong throughout 2023. And it hasn't just been leftover momentum from the past two record years. So while overall demand through the first three quarters of 23 is down about 52% compared to last year and 58% compared to 2021, which sounds pretty dire, it's actually right in line with what the market was recording in 2017, 2018, and 2019. And it may be hard to remember, but that was one of the better industrial markets that we've witnessed. It just puts into perspective how extraordinary and unprecedented the frenzied demand that we've witnessed the past 2 years really has been.
That's fascinating. So, So you're saying we're down? It sounds like about 50% in. Is that overall net absorption?
Right.
Between
Yeah. So
those
net
2 years?
absorption is what we use to measure demand. You know, it's defined as the net change in occupancy from one period to the next. So it's really our main indicator to measure demand. And so through the first three quarters of 23, it's totaled about 179 million square feet nationwide. I'm projecting that it'll land somewhere around 256 million square feet by the end of the year, which is exactly the annual average that we saw between 2018 and 2020. So it's right in line with where we were pre-pandemic.
So we're right back to what you would say is a good and healthy market pre-pandemic.
At least so far through 2023 in terms of demand. Now, on the other hand, new supply or construction completions are expected to total about 630 million square feet by the end of the year. That's almost 2.5 times the expected demand total for 2023. Now, about 85% of this new construction is spec, and a good chunk of it isn't pre-lease. So this dump of new product is the main reason why vacancy rates are climbing in about every market in every region throughout the U.S. Typically, that kind of supply-demand gap would be a cause for concern in the sector due to overbuilding. But the good news is that interest rates and demand concerns are shutting down construction starts nationwide, and the construction pipeline is quickly contracting. So we're able to forecast with confidence based on this anticipated construction completions and pre-pandemic demand that the U.S. industrial vacancy rate, which dipped as low as about 3.5% last year, will likely stabilize around 6.5% towards the end of 2024, which is just a hair above the 15-year average of 6.2%. I would argue that that rate is a healthy figure where tenants have more options to lease and that they've had in years, and the market isn't overbuilt.
So would you say that the amount of construction being delivered, now is a hangover from over projections because of COVID?
I don't know if it's over projections. It's a reaction to what happened in 2021 and 2022. Demand shot through the roof. Never seen those numbers before.
Yep.
And developers started to build to meet that demand.
Right.
They anticipated that demand to continue, and it did continue. And while it's fallen off about 50%, we're still seeing a good amount of demand. But right now, at least for the time being, we're building more space than we're leasing. So there is an imbalance, but the good news is that imbalance will not last.
That is That's great perspective, Craig. Let's talk about some of the top performing markets that you've seen across the US. And let's stay on the leasing topic for now. What have been the top, would you say, three markets from a leasing standpoint in the US this year?
So if I were to base my answer entirely on volume, the answer would be the three largest industrial markets in the US. So you'd have greater LA, which includes the Inland Empire, you'd have Chicago, and you'd have Dallas. Now, each of those markets is enormous, over 1 billion square feet in size each. However, if we look at volume, leasing volume as a percentage of the market's overall size, the markets that actually top the list are those that are growing fastest. So Savannah and Charleston have each grown their inventories by about 13% year to date. And similarly, they have each seen the greatest leasing volume as a percentage of that inventory so far this year. Indianapolis has grown nearly 10% so far this year, and they're third on the list. So that's really one of the reasons why these markets are growing so quickly is that demand has been there and the leasing volume has been there.
What would you say are the trends that you're seeing, post pandemic 2023? What are the top trends you're seeing right now?
But we're at a pivotal time, right? So trends are shifting, indicators are shifting, the market's shifting. So the trends that we've seen, the significant speculative development of warehouse space, while that's fading away, we're seeing some new trends emerge. So, for example, reshoring and nearshoring, they've been buzzwords for years. I've been talking about them. I've been saying, they're buzzwords. It's not really a real trend, but now the trend is the real deal. So while developers are pulling back quickly on warehouse and distribution development, manufacturing construction spending has never been higher. So while most construction has been concentrated in semiconductor and EV battery facilities, it's also increasing for food and beverage processing, chemicals, and plastics factories as well. Another trend we're seeing is demand for cold storage facilities has taken off. And much of the freezer cooler space in this country is about 30 to 40 years old and basically functionally obsolete. Now, despite that inadequate product, vacancy rates still hover around 3% for cold storage buildings. And developers have started to build cold storage product even on spec. I'm tracking about 18 spec cold storage facilities totaling about 4.7 million square feet built nationwide since 2022. And there's another 15 buildings totaling about 3.5 million square feet that are under construction or about to begin. The third trend that I wanted to mention was data center growth has been a trend for years, but doesn't look to slow down in 2024. The rise of artificial intelligence is leading to a new era of data center demand. And this will lead to the need to modernize power grids, including more transmission lines and relying on multiple energy sources. So that we're going to see plenty more data center growth in 2024 and beyond.
That's interesting. It seems like rates are stabilizing a bit in a lot of the key markets. Would you say that's consistent with what the volume that we've had and absorption we've had over the past few years? It seems like rates are stabilizing. Would you agree with that?
Yeah, I would agree with that. Industrial rents continued to climb at an unprecedented pace, even in the first half of 2023. I think towards the end of 22 and early 23, they peaked at just shy of 20% year over year growth. In some markets, that growth climbed to over 25% year over year. Those are previously unheard of rental rate growths for industrial lease rates. While rent growth may pause in 2024 in some markets where rates got just a bit out of hand in the last few years, rent growth is still expected to continue overall, although it'll be closer to historical averages, somewhere between 4 and 8%, which is more in line with what we saw historically. Also, I wanted to mention while rents have shot up, so have escalations. Average bumps were historically about 2.5% for what felt like forever, until only recently when we started seeing more and more leases signed with 3.5% bumps, 4%, or even 4.5%. So far, rent for leases signed in 2023 have increased to about 3.6% on average.
Craig, I mean, with all the change this year over the last couple of years, I would say from our perspective, there isn't a bigger change than capital markets. Tell us about the trend there and what the changes have been.
Yeah, so that is very true. Sales volumes off an average of 64% for all commercial real estate product types year over year. And while it's 64% for all types, industrial is actually off the least at about 47%. That's still a significant drop. While several markets like Dallas, Houston, Chicago, and Phoenix are each down well over 50%, others haven't been quite as impacted. I think sales volume is only down about 10% in the Inland Empire. 15% in Minneapolis, and 28% in northern New Jersey. Looking forward, the interest rate environment will continue to dictate when buyers re-enter the market. At that point, once we have established some idea of pricing, things will pick back up again, but it'll still be a while yet.
Yeah, those are interesting figures. It's certainly off in our market more than 47%. But, we hopefully first quarter, there's some things that'll trade. So that should help us kick off the year pretty strongly. Give us a bold prediction for 2024.
I'm going to remain an optimist here. I'm going to say I expect the industrial market to reset by the end of 2024. We're going to come to the end of what's been a record-long 10-year development cycle. I think the equilibrium between supply and demand, which is, off right now, will return by next winter. And when that equilibrium returns, vacancy rates will stabilize. Some markets where too much space is being built right now will stabilize at a much higher rate than others. Those markets will have some work to do in 2025 and beyond to come back down to earth. But overall, the U.S. industrial market is in good shape, and the upcoming pause in spec development is likely the best news for a market that's reached a pretty pivotal point in time. It'll allow time for industrial users to absorb much of the modern space that's currently being completed. And based on these predictions, I think the next cycle really isn't too far off. It'll be here before we know it.
Yeah, that is great. So let me ask you another question. If you were investing your money in a market, what are one or two markets you'd be investing in right now?
I'm not an investor. There's the stump question.
There you go. Yeah. Maybe some emerging markets. I mean, you mentioned Savannah, right?
Yeah.
And some of the, I mean, Miami's a great market, right? I mean, it seems like South Florida's
a very solid market.
Yeah.
So one of the first things I did when I took my new job at Colliers was I built a forecasting tool, because as I mentioned earlier in our conversation, there's so much space being built right now, but that construction pipeline, is about to really drop off, which is actually good news for the market. Some markets are building a little bit too much space and their vacancy rates are going to climb pretty high. Some markets, they're kind of coming to the end of their cycle and, their vacancy rate is about to flatline. So it's in some of those markets where vacancy is already just about at its peak. I think those markets will turn around more quickly than some of the others. Now, Savannah is an emerging market, but it's got a ton of space under construction. I think the vacancy rate will climb well into the double digits going forward. Dallas has a lot of space under construction. Phoenix has a lot of space under construction based upon its overall inventory size. I think some of the markets that are a little more established might be a good place to invest, because while there's space being built in each of those markets, your inventory is so large that as a percentage of the overall inventory, it's not going to have as negative of an impact on the vacancy rate as some of those more emerging markets. So Minneapolis, Chicago, Detroit, a lot of the markets in the Midwest, those are industrial markets that have been around for a long time. And they've been solid for a long time. And I think they're a solid investment, in my opinion.
Yeah, that's a really good point. Last topic I want to ask you about: subleasing. We've seen a lot, sublease, a big uptick in our market and certainly up and down the West Coast. Are you seeing that nationally as well?
Yeah, nationally, I think the figure that I just ran an analysis today, and I think the figure that I saw was it's now up to about 0.7% of the overall inventory. While there is a story there, historically, I think the average is about 0.6% over the past 20 years. It's been higher. It's been lower, especially the last few years. It's been lower. It's on the rise, but it's not getting out of hand. And I think one factor that we need to consider is that rental rates have climbed so quickly that some of that space that's on the market for sublease is basically space that's being underutilized by tenants, and they see that their neighbor leases out, leases a space for well above what they're paying. And they say, "Oh, we're not using this 50,000 square feet. Let's throw it on the market and see if we can get a tenant to lease it, and see what we can get for it." I think that we're seeing a little bit of that.
Yeah, that's good perspective. So it sounds like it's really at the historical average of, when you look at overall subleasing vacancy. Well, Craig, you've been awesome. This has been super insightful, great perspective nationally on it, and then some really cool points on some of those emerging markets as well. So really appreciate you joining our podcast and appreciate you taking the time.
Guys, thanks so much for me. I'm happy to do it anytime.
Awesome. Thank you.
Thanks a lot.